All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We have a market that just kind of sitting here all day from its gap on some of the Brexit optimism here, and then some of the better than expected earnings. I think is the best way to phrase that. And we'll go look at that with Honeywell here in a moment. But let's start with the challenge. Challenge is in all cash, waiting to trade the next signal. And we have a signal on the board. Now, the signal that's on the board is Coca-Cola. I'm not going to go trade Coca-Cola. Why? Well, very simple. Coca-Cola has earnings in the morning. And with the challenge not over 10,000, I'm just not going to trade. Not going to take the earnings risk here with it. The options are a little bit elevated, but they're not horrible for going into earnings or anything like that. But again, as per the algorithm, once we get over 10K, we'll trade some earnings. But until then, we'll stay away from earnings just simply because of that risk factor and the fact that if I go and I make a Coca-Cola trade, right, and Coca-Cola decides to tank on earnings, which could easily happen. I have an option that's essentially going to go to zero very quickly, and so not a position that I want to be in, not a position that it's worth putting the challenge in, here early on in the challenge, and we're still in the very early stages, and so want the highest probability with best risk reward, so we'll not take Coca-Cola, here, even though it is triggering bullish today. Now, as far as the other crossovers that are out there, on the downside, we have IBM and we have Schlumberger. Schlumberger here is not a signal. I thought, had a chance to be. Schlumberger also has earnings here soon, but no new signal there on Schlumberger. And IBM had earnings last night after the bell, and been going through them here today. Very interesting earnings. I think you can compare these earnings and kind of what the earnings mean for IBM to kind of back in April. I would not be surprised to see IBM struggle to really find buyers over the course over into the end of this year. But I would not be surprised to see IBM get bought up aggressively come the beginning of next year. That's kind of what I'm looking at there. With that. So those are the downside crossovers. Again, I'll play IBM no matter when it happens that we get a signal, but no signal here on it. And then we have the bullish crossovers here, which include Coca-Cola, Vulcan Materials, and Juniper. Consolidation risk on Juniper very high right here, and same thing for Vulcan Materials, VMC here, both with very high consolidation risk elements. All right, so not going to make a change for the challenge, not going to make a trade right here. Let's go take a look at a couple things here, though, that are going on. We have the market up, 0.2% today? But notice the volumes here on the SPY. The lowest volumes of the month this week. Now, we expected low volume on Monday. Why? Well, because we had a holiday. Okay. September. All 4 days in the market this week have been lower volume than any day in September. They're all lower than any day in August. We have to go into the summer month, the dry kind of July here to find where some of the volumes rivaled. The last couple times we've seen the market get this low in volume, the market's been in a very similar position. Back here in April, back here in July, where it has made a small move higher. Nothing dramatic, but just a small move higher. Nothing that's going to stand out, big on a monthly chart or anything like that. And then what this market has been doing after these small moves is it's just been drying up. The volumes have been drying up. It hasn't been overly bearish. It hasn't, seen strong, gains afterwards. We've seen the market go into, chopped phases as the volumes have gotten to this point this year. Now, I don't expect the same action that we saw in April and July. I have to respect the fact that it could be. But we are seeing those volumes really dry up. We're not seeing an aggression in terms of the buying and the selling that's out there market wide. We are seeing, some aggressive action in individual stocks based on earnings. But in terms of the overall market wide action, we're not seeing a whole lot of aggressive action there. And low volumes, a lot of people look and go, well, low volumes, that means that we're going to go up, we're going to go down. Now, low volumes simply mean nothing's changing, right? Nothing's really changing in a dynamic way. It's not something that's super favorable for the bulls or super favorable for the bears, or where you look and go, well, you know what, this rally doesn't mean anything because it's low volume, so it has to go back down. Yes, all those things could happen, but when we look at volumes, the lower volume periods historically in the market, they tend to be slightly higher, but on a very much snail's pace higher when they move. And again, that's market wide. That doesn't mean individual stocks and everything else are stuck into that. But that's what we're seeing right here, and that's what I take from the lower volumes. Now, Honeywell reported earnings here this morning, big industrial, and an industrial that from a revenue side has been contracting. And you see some of the revenue contraction here. Now, some of this has to do with some parts of the business that have been sold, but 16% revenue contraction year over year. That's what they reported this morning. That's an ugly number, right? That's an ugly number. 16% revenue contraction. You expect what? Honeywell's down big. Oops. Not only is it up big, it's been bought up all day. Right? It has been bought all day. And to me, this just speaks volumes. It speaks volumes about what the real expectations or worries of the market are and have been. And they have been that, hey, things are going to be worse than expected. And, you say, well, how can they be worse than expected? Well, worse than what the numbers out there suggest they are going to be. And, the market has not gone into this earnings season with a super optimistic, rosy outlook on things, even though it's sitting near new highs, right? If we judge the market based on where it is, people say, well, it's overly optimistic. But if we judge it where the sentiment indicators are, it's nowhere near overly optimistic. In fact, we could argue it's been way too pessimistic. And you look at something like a Honeywell, and the earnings, earnings growth. They went back to growth. They've been 3%, minus 2%, 0. Now they're at 2%. Next quarter, 7%, 8%, 10%. They're looking at double-digit growth going forward. That's pretty darn solid. That's something investors can get behind. And even with the revenue looking at picking up and starting to go from this contraction phase into this growth phase. And so we have a stock here with Honeywell that, while they've gone through a revenue contraction, has consolidated, and is consolidated for 6 long months where the stock simply has not gone anywhere. Now signs pointing that it's moving into more of an expansion phase. We can see the stock make one of those really strong type of moves. And what do I mean by strong type of moves? I'm talking about 160, 170 up to the 210, 220 area. I'm talking about this type of move that we saw from December of last year into April of this year, where the stock, makes that kind of 40-point move. This type of move right back here where it just goes to a different level. And I think that potential for Honeywell is very strong given what we've seen on earnings. Now, are investors ready to do it just right here, right now? I think investors in general are going to want to look and see, okay, how does the rest of earnings season shape up? But when earnings season winds to a close and investors look over all the earnings out there and they look over the stocks that they need to be involved in, I think Honeywell is going to be one that's near the top of their list, and I think it's going to be one that's probably talked about very, very little. So definitely one to keep on your watch list. Keep an eye out there if you're looking from an investor standpoint. Hi, Tony. Take a look at Honeywell. Again, I would be buying it, chasing it here today. But when we talk about, one of the troubles for investors over the last while has been the fact that some of the better stocks out there, like Honeywell, are in these revenue contraction phases. Well, if we start to see stocks like Honeywell moving out of these revenue contraction phases, they have a long way to go. And they're definitely worth having on that watch list and being involved with as the market goes forward. Now you take a look at something like an IBM, right? IBM's earnings contracted 22% year over year. That's a pretty monster number. It was expected, right? It's not like it caught the markets off guard. But here, they continue into this revenue contraction. They haven't been able to go into this revenue expansion. But when we look at the numbers, it does suggest that we may be talking about revenue expansion as early as next quarter with IBM. And that's one of the reasons why I said earlier, I would not be surprised to see IBM sold a little bit more over the course of the next 4 to 6 weeks, and then get bought up aggressively before the next earnings season. And so, two that I think are better than expected earnings. Right? Yes, I know the reactions are very different, but the way I'm kind of looking to play them, and more importantly, kind of pull an investment in them. Again, they're both on the challenge watch list. I'll trade either of them with any signal that comes on the board when it comes on the board. But I would not be surprised to see some pretty good signals during the course of this challenge with both of these stocks, and look forward to playing those. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.